Good afternoon, everyone. It's a pleasure to introduce myself and also our event for this afternoon. So I'm Manveen Toohill. I'm the L&D manager at the Managing General Agents Association, and on behalf of the MGA, I'd like to welcome you to this market briefing with Insurance Data Labs. Before we start, some housekeeping to cover, and for those of you that do attend regularly, I appreciate this is probably the same, so no surprises, but please do ensure that you keep your microphone and camera off, just because it allows us to kind of keep the bandwidth and we don't have any dropouts. We also ask that you do not use any AI note-taking tools as well, just because we don't have permission to use that, so we ask that you don't use that. Questions are welcomed and encouraged, so you can use the chat function to do so, but we'll also have a Q&A session at the end. And we are recording this, and a link will be sent out after the recording and posted on our YouTube site. There'll also be a feedback survey, so we do welcome your feedback. Shouldn't take you more than 2 minutes, but it'd be really good to get your insight on our market briefings and any future possible events and what we can do to continue giving you information. And then final one from me is that our market briefing sessions are accredited by the CI for their content and quality. So if it does align with your development needs, you can add that to your CPD log. So without further ado, I'm pleased to introduce you to Matt and Dan. I'm going to hand over to them for our session today.
Brilliant. Thank you very much. And good afternoon, everyone. Welcome to today's MGAA webinar on the capital performance of capacity providers. I'm Matt Scott, and this is Dan King with me, and we are the co-founders of Insurance Datalab. Our aim today is to give you a clear data-led view of how capacity providers are performing financially, and also what that means for MGAs in today's market.
So for those of you who aren't familiar with what we do, we analyse the performance of insurers, MGAs, Lloyd's syndicates and brokers across the UK, Gibraltar and Ireland. Our insights cover everything from underwriter performance and financial results to customer experience, claims and complaints handling. And all of the data you'll see today comes directly from our market intelligence platform, which covers more than 1,000 brands and companies operating in the non-life market. And we help MGAs to evaluate capacity providers and distribution partners, support compliance and M&A activity, and benchmark performance. And as part of our partnership with the MGAA, all MGA member firms benefit from an exclusive 10% discount on the price of an annual subscription. So email me if you'd like to know more about that at dan@insurancedatalab.com.
Now, before we get into the numbers, we're just going to bring the learning objectives back up on the screen now. So we're working towards these three objectives today, and by the end of the session, delegates will be able to describe the key measures of capital performance and how they apply to insurers providing capacity to MGAs in the UK. Explain how insurers' capital strength influences things like underwriting capacity, product innovation, and also the MGA broker relationship. And then finally, summarise recent data on the capital performance of UK capacity providers and outline what that means for the sustainability of MGA partnerships. And a quick reminder again that this session is CPD accredited, so don't forget to record that if it aligns with your development needs.
So first, it's worth reminding ourselves why capital strength matters. Obviously, as MGAs don't hold regulated capital, the balance sheet risk sits entirely with the insurer, and the insurer's capital position dictates three things that shape every MGA relationship. First, appetite. So when an insurer has strong solvency coverage, it gives them the freedom to deploy capital. They can support new MGAs, increase capacity lines, or back niche propositions. When solvency tightens, the opposite happens. Appetite shrinks, approvals slow, and deals stall. Second, sustainability. A capacity deal is only useful if it continues. Strong solvency positions mean insurers can absorb volatility. A bad quarter, a spike in claims, a rough line of business, without pulling the plug. Weak solvency means insurers become defensive, and MGAs often feel that before anyone else. Third is innovation. New propositions require capital confidence, whether it's embedded products, parametric triggers, automation-heavy models, or new forms of distribution. Insurers need to be comfortable backing something untested. providers with strong solvency are more willing to do that. And those under pressure often end up reverting to their core business. So capital is not just a compliance measure, it dictates how much insurers can support MGAs and how much they want to.
So one of the measures that helps determine capital strength is underwriting performance. A business that delivers stronger underwriting results is going to have more readily available capital than an equal company that doesn't. So let's start with taking a look at the wider market first. And the chart you can see on the screen now shows the underwriting performance of the combined UK and Gibraltar market over the last 5 years across all lines of business. You can see loss ratios rose from 59.3% in 2020-21 to a peak of just over 67% in 23-24, before easing slightly back to 65% in 24-25, the most recent results we have. Meanwhile, expense ratios have improved steadily over that period, going from 38.9% down to 31% last year. So the overall picture really is one of, I suppose, claims inflation pushing the market hard, especially in 2022 and 23, followed by a correction in 24-25 as premiums caught up with claims. And this is all taking place in a growing market, with net earned premiums growing by around 37% over this period. And most of that is, I suppose, rates rather than exposure driven. So when we see the core falling, it's largely thanks to pricing rather than a sudden improvement in underlying claims.
Now let's focus on capacity providers, so those insurers that are backing UK MGAs. And two things stand out really clearly. The first is a much more stable loss ratio, and in recent years, a better loss ratio than those insurers that don't provide capacity. While the market encompassing all insurers, shown here in the pale bars, swings from 59 to 67%, those providing capacity barely move. They sit in a tight band between 58 and 60% for the entire period. That's exceptionally stable in a volatile market. Now, of course, some of this can come from the more diversified nature of some of these insurers, which includes some of the largest players in the market. But it also shows how MGAs can help deliver strong and consistent underwriting results for providers. And being able to demonstrate this stability is key when talking to capital partners. It helps frame your performance in a way that they recognize and value. Second is underwriting profitability. Now, the market as a whole fell to an underwriting loss in both 2022-23 and 23-24, whereas the capacity provider cohort has been profitable in each of the last 4 years and has outperformed the wider market in each of those years too. So these results have been less volatile over the last 4 years too, something that's extremely important for insurers and their shareholders, who hugely value predictability. Now, while this isn't solely driven by MGA business, MGA-delivered portfolios certainly contribute meaningfully to that performance. And the more profitable and sustainable these businesses are, the more likely they are to continue backing MGAs with capital.
Moving now to solvency and specifically the solvency coverage ratio, or SCR. This measures the ratio of an insurer's available capital to its solvency capital requirement under Solvency II and now Solvency UK. So this is monitored by regulators, and if an insurer gets close to or below 100%, which is roughly equal to a 1 in 200-year event, then there are various levels of intervention that the regulator could take. This includes requiring an injection of fresh capital to bring the ratio back up, or stopping businesses from writing new business. For MGAs, this means that if your capacity provider's ratio dips dangerously, then the PRA could prohibit the insurer from writing new policies or even force it into runoff if things go bad enough. Clearly, this would significantly impact your ability to write business, which in turn would damage client and broker relationships. So it's worth understanding that brokers appreciate the benefit of having this capacity with real financial strength behind it as well. It gives them confidence in the resilience of your products, and that not only will you be around to pay claims, but also to offer continued access to your products as well. And obviously, with the capacity provider sitting behind that, it's your reputation that is on the line. So looking at the numbers on the screen now, across the whole market, which are in those pale bars again, the SCR has sat between 175% and 186% over the last 5 years, with a nice healthy buffer above that 100% level. Capacity providers sit slightly below that, averaging between 167% and 178% over that same period. Still really strong, and it shows a good degree of capital efficiency there too. Um, One thing to point out is that across both of the cohorts, we can also see a strengthening of that solvency position. 24-25 is actually the highest of the last 5 years for each group of insurers. And that's largely down to the increased uncertainty we're seeing in the world at the moment, as well as claims inflation, making insurers that bit more nervous about the future direction of claims.
But of course, the aggregate position never paints the whole picture. So we've also taken data from our platform looking at the individual insurers in the market that deploy capital through MGAs. And these are the companies that make up the cohort for the aggregate positions we've been speaking about. So this chart shows the range of solvency coverage ratios we see in the capacity provider market for 2024-25. And it goes from 137% at the bottom end all the way up to 614% at the top. But the median sits at around 184%. But there are a couple of outliers at the top end there. So those two top insurers are small specialist players, and they're skewing things a bit. So I'm just going to remove them from this view. And what you can see now is that most providers cluster around between 160 and 190%, which is in line with what we usually see in the market, with solvency coverage ratios often being targeted at around the 180% mark. And this is important for MGAs to understand because, as we said earlier, the more free capital an insurer has, the more they are able to back new opportunities and offer new or extended capacity deals. So it's really important to understand these figures, either when going out into the market to look for new capacity or when negotiating existing deals.
So that's the financial performance picture, I suppose. Kind of strong underwriting, stable solvency, and disciplined expense control. But capital strength alone doesn't tell you what capacity providers want. It doesn't tell you what kind of MGAs they're willing to back, or where the appetite is growing or shrinking. For that, we turn to some research we published earlier this year with InsurTech UK that aims to explore insurers' appetite and key considerations for working with InsurTech MGAs through a survey of capacity providers that took place between November 2024 and January 2025. The headline finding from that research is that the appetite for backing insurtech MGAs is probably a bit stronger than many people think. So the respondents to the survey, 81% of them said they were likely to provide capacity to a new insurtech MGA this year, while 75% said they would recommend working with insurtech MGAs to peers. The respondents were also very clear that they expected premium volumes to increase across all lines of business this year. So that's really encouraging for the market. And this is despite a cautious investment environment, I'd say, and continued economic pressures. It shows confidence in insurtech MGAs is becoming more mainstream and I suppose following the fortunes of that wider MGA market, which, as you all know, has become a real powerhouse in UK GI in recent years. The full results of this research are available in a report that we published with InsurTech UK, as I said. It's called Access to Capacity, Ample or Absent, and that can be downloaded free of charge from our website at insurancedatalab.com. The survey, it took place around a year ago, as I said, so it'd be great to see what you all think of the market for capacity right now. So we're going to do a quick poll, and that's, do you think available capacity has increased, decreased, or stayed the same over the last 12 months? So hopefully that's popped up on your screen. I'm seeing some answers coming in, so that's live there. It's more of a market view, this, rather than thinking about your own businesses, but it'd be great to see kind of what you all think. We're about half of you responded now, so it's ticking up nicely. So yeah, around 13 of the 20 people have replied. It seems to be pausing there now. So we're seeing, well, what are we looking at? Most people are saying increased kind of capacity. So 9 of the 14 people have replied. A couple of people have said decrease, and then just 3 have said stay the same. So that, I suppose, kind of ties in with kind of what we were seeing from insurers at the start of the year. So it's good that it looks like they're following through on what they were saying earlier on.
Great. Okay. So insurers are telling us that they are keen to deploy capital. And thankfully, you're saying that you're seeing something similar playing out in practice. But what do insurers need to see in order to actually get that capacity out in the market? So let's start with premium expectations. Across the survey, the most common minimum premium expectation was between 500,000 and £1 million in year one. That's the level that insurers feel the economics begin to make sense. Enough scale to justify the operational load, but also enough volume for the loss ratio to actually mean something. 25% of insurers expect between £1 million and £5 million of GWP, while we also saw a quarter of insurers expecting to see between £100,000 and £500,000 of premium. 13% expected more than £5 million in year one, while a small minority, just 4%, said they would be happy with £100,000 or less in that first year. So, while there is appetite for innovation, insurers still want it to be taking on a decent sized market. And this shows how providers want new MGAs to hit the ground running with a credible volume plan.
And as part of the survey, we also looked at kind of expectations around underwriting performance. So across all of the respondents to the survey, the average acceptable score was 78%. And I suppose that tells you everything you need to know about discipline in the current market. It's not an easy target, a core of 78%, but it reinforces, I suppose, insurers' expectations around sustainable profitability. There is, of course, some nuance to that. So as you can see on the screen, just under 1/3 of insurers said they would accept a core of up to 100%, over 90% in those early years, particularly where there's growth in the business or learning or product refinement happening. But this is the critical point, I suppose. No insurer said they accept above 100%, and in fact, most sat in that 70% to 80% range there, as you can see. Despite this, 42% of insurers said they would support a short-term loss-making opportunity. That's encouraging to see, but it's important to remember that in this case, short-term really does mean short-term because, as I said, they're all expected to see underwriting profits in that first year. And that's an important nuance really to take into your capacity conversations because insurers, while they're not asking for miracles, they are asking for a credible, evidence-based path to sustainable underwriting profit. And that's really crucial for MGAs because knowing these expectations up front changes how you pitch, what information you prioritize, and how you position that early stage underwriting performance. Insurers don't just want to know whether you're profitable. That is, of course, key, but they also want to know how predictable you are with your core and your forecasts. So one of the most powerful things an MGA can bring to the table is something like a simple volatility analysis. So showing how your loss ratio behaves over time, breaking out the drivers that may underline that volatility, and crucially showing how your portfolio performs, relative to the insurer's own book of business and also the wider market. That's because if you can demonstrate that your portfolio behaves in a tighter band, or failing that you understand at least the reasons behind that volatility, that immediately strengthens your position in any capacity discussion.
So we also asked underwriters what most influenced their decision to work with an insurtech, and one factor stood out above everything else: access to their data. This scored an average of 4.59 out of 5, and almost 2/3 of respondents said it was very important. So data really is the critical driver in these partnerships. You can also see the other leading factors on the screen, from the insurance expertise within the team through to the uniqueness of the product proposition and distribution model, and then elements like historical performance and the ability to plug into the insurtech's technology infrastructure. And right at the bottom, we have the brand, which, while still relevant, clearly carries less weight than the more operational and performance-led factors. What this really shows is that capacity providers are making decisions with a long-term mindset. They're prepared to wait for MGAs to establish themselves, provided the fundamentals, particularly the data and expertise, are strong.
So we know that data and expertise are what really sway these decisions, and the challenge then, I suppose, becomes proving it, and that's where benchmarking plays a crucial role. So one of the most effective ways to build confidence is to show where you sit relative to the wider market and comparable portfolios of business. So this means benchmarking things like your core, your expense efficiency, growth trajectory, and things like claims frequency and severity trends. And you can compare that against the market, the specific insurer that you're speaking to, but most importantly, the relevant business lines that are comparable to what you're underwriting. Because if you can show your core has been performing better than an insurer's internal book of business, then that really strengthens your position during these negotiations. And if it hasn't, then you need to be aware of that and be able to explain the reasons for that difference and what you're doing to improve. Insurers want MGAs who, I suppose, understand their own numbers as well as the insurer does, and benchmarking is the most effective way to show that.
So let's bring both parts of the story together. Financial performance shows a cohort of insurers that are stable, well capitalized, consistently profitable, and improving their expense efficiency. And our research shows that insurers are more willing than ever to work with MGAs, are especially open to innovative propositions, but are still being selective in who they work with. So the headline is pretty simple. Capacity is available, but MGAs must meet a clear, high bar to secure it. Insurers want data, discipline, expertise, and differentiation. They want MGAs who understand their own numbers as well as the insurer does, and they want reassurance that the proposition is sustainable. MGAs who present that clearly and understand their position in the market relative to both other MGAs and the more traditional insurers are the ones most likely to secure long-term scalable capacity.
Now, before we wrap up, we wanted to touch briefly on something a bit more practical, and that's how MGAs can use the kind of data that we've shown today to really strengthen their capacity conversations. Because the MGAs who secure the best partnerships aren't just the ones that are performing well. They're the businesses that are presenting their performance in a way that aligns with how insurers think about capital, solvency, and risk. And a lot of that comes down to using the right evidence. And here's a few ways that we think you can do that. First is something that we've already touched on, and that's benchmarking your core against the provider's own book. Insurers often look at new opportunities through the lens of their existing portfolios and the way they do business. So being able to show clearly and objectively how your core compares with their internal book of business immediately gives them something familiar and meaningful to anchor to. It reframes the discussion from here's our core to here's how we can improve your core. And that is really powerful in these talks. Second is around showing your volatility relative to the market. Underwriting stability is so important for insurers as it allows them to plan better and manage their strategy with more confidence. It also allows them to better manage their shareholder expectations. Using volatility quartiles, for example, showing whether your loss ratio sits in the lowest 25 or 50% of the market for volatility, is incredibly powerful. It allows insurers to see not just where your number is today, but how consistent it is over time, and how that compares to the market they already know. It's a really powerful way to build confidence in your offering with hard data-backed evidence. Third is about understanding the insurer's capital position. So every capacity deal has to make sense from a capital perspective for the insurer, and solvency ratios shape how much headroom insurers have. So being able to understand how well capitalized a potential partner is, how their solvency has shifted year on year, and whether they have capacity to support the growth you're planning really helps an MGA target the right partner. And it helps insurers to see that you've done your homework too. The final point here relates to understanding where an insurer is focusing their growth ambitions by using things like year-on-year premium trends to frame your conversations. So understanding how an insurer's capacity appetite has changed over time, whether they've been expanding, contracting, or reallocating to a different class of business, is incredibly valuable. It lets you position your proposition in the right part of their portfolio, and it signals that you're approaching the conversation with a long-term perspective, not just a simple request for capacity. So None of this is about selling anything about your business. It's not about saying what makes you unique or different, which is, of course, important. It's simply about using the right data to speak the insurer's own language. When MGAs can benchmark effectively, demonstrate that stability, and target partners who capital positions align with their own growth plans, that's when conversations become easier, faster, and much more productive.
So I've put our learning objectives back onto the screen as a reminder of what we've discussed today. And I'd also like to remind everyone that the report on insurer appetite to provide capacity to MGAs is available to download for free from our website at insurancedatalab.com. And all of the data that's underpinned the insights we've shared today is available on our market intelligence platform, where you can also see the underlying data on a company level broken down by line of business. And if you'd like a deeper understanding of your capacity partners, or if you want to benchmark your own performance against the wider market, we'd be really happy to walk you through the platform. And as I mentioned at the start, all MGA members can benefit from a 10% discount. We also publish annual broker and MGA performance ratings, which analyze how companies fare across three pillars of performance: profitability, productivity, and growth. And we can be commissioned to delve into this further through custom reports and research. So please do reach out and request a demo if you have any questions, or if you have any questions, we'd love to show you more. And I'll leave our contact details on the screen as we move into the Q&A section of the webinar. Thank you.
Fantastic, thank you both. We've actually had a couple of questions come in already, but I've left the chat open for anyone that might be typing. The first question that we've had come in: what are some of the common reasons capacity providers decide not to offer capacity? So I'm going to throw that open to both of you there.
Yeah, so we actually looked at this as part of the InsurTech UK kind of research as well. And the way we did that, we looked at, I suppose, kind of external and internal barriers from an insurer's point of view. So things about kind of doubts about the team expertise, the underwriting discipline, kind of feeds in with what Dan was saying earlier, maybe. And also accessing claims data. If you can't access that claims data, that was a big barrier from an insurer's point of view. And also around kind of the funding of a business, how well funded they were or not was another barrier. But there are also, I suppose, barriers internally within the insurer itself, which obviously is harder for an MGA to kind of combat or deal with. But that's things like lack of understanding of the opportunity, or a lack of appetite internally, or not aligning with the provider's strategy. Difficulties in maybe conducting due diligence, and a lack of experience of dealing with MGAs was another one. And while it's maybe a harder one to deal with, I think it's all about being clear about approaching the right potential partner, understanding their business, so that you can approach the right one, and there's going to be that connection there, but also making sure that you're kind of clear in how you present your proposition to make it as easy for them to understand, and provide them with as much information as you can, really, so that due diligence is made a bit easier.
Fantastic, thank you. And again, another question that's also come in to the chat as well. We've got: for MGAs without a long underwriting history, what's the most credible way to build insurer confidence in the absence of multi-year performance data?
Yeah, so that's a tricky one, I suppose. Although the fact that kind of historical performance data maybe wasn't as high on the list when Dan read out those decision factors earlier is probably a bit encouraging. But I suppose it's all about demonstrating your expertise, really. So showing that you understand the market that you're looking to enter and that you'll be underwriting in. You understand how it's performing and why it's performing in that way, who the main players are, and what the challenges and opportunities are as well, I suppose. And then being able to, with your forecast for your performance, show that they're, I suppose, grounded in reality. You can't just go and say you're going to knock 20% off the loss ratio and expect someone to believe that. It's got to be grounded in realistic, ambitious but realistic, and then backing that up with why you think you can achieve that, what makes you different, and what sets you apart from the rest, I suppose. And then also it's all about, I think the relationship is probably more important than people realize. And I think showing that cultural fit with the partner you're talking to, and how your proposition will fit into their existing business, how it will complement their internal book is important, because if they've already got a very similar product that they're running internally, it could be seen more as competition than complementary. So I think that's important to understand as well.
So thank you. I mean, I think you've covered everything in great insight and detail. With just one or final ones popped in, just as I was about to kind of say we haven't got any more, but one final one is if an MGA is operating in a class where market loss ratios are volatile, how can they best frame their story to a cautious capacity provider?
I suppose it's all about context again, really. So if you're in a volatile market, that's fine. An insurer will understand that. They understand that kind of risk is part of insurance, and you're going to have that uncertainty and that volatility. I think the key thing is to show where you sit within that. So hopefully you've got a proposition that has kind of better volatility, or kind of better performance, and being able to showcase that and the relative performance is key. And then it's all about, again, explaining what the whys. Why is there volatility? Show that you understand where that uncertainty lies and what you have in place to best manage it. So even if there is a large amount of volatility, a large amount of uncertainty, showing that you understand it and you're minimizing that to the best of your abilities, I think that's key. And that's probably what I'd say to that one, yeah.
Fantastic, thank you. That does look like it is the kind of the final question that we've had in. So I think all that's left to do is to wrap up for today and thank everyone for joining us for the session, and mainly thanking Dan and Matt for their time and giving insight. And again, thank you all for your time today. Hope you have a lovely rest of day all.
Thank you.
Thanks, everyone.
Thank you.
Cheers.
Bye.